Imagine covering your phone bill, your Netflix subscription, or even a small grocery run without lifting a finger. Sounds great, right? Today, I'm going to show you 3 realistic ways to earn $100 a month in passive income, even if you're starting with a small amount of money. No gimmicks, no get-rich-quick schemes, just smart, practical strategies that actually work. Passive income might sound complicated, but it's really just about setting up cash flow streams that keep paying you even when you're not actively working. Whether you're looking to cover a single bill or aiming for full financial freedom, these methods are designed to get you started with realistic and manageable steps. So, if you're ready to build wealth without needing millions, let's dive right in. First up, one of the most reliable and proven methods to earn passive income: dividend ETFs. Dividend exchange-traded funds are essentially baskets of dividend-paying stocks bundled into one convenient investment. The best part? They pay you regular cash distributions just for holding them. Now, to earn $100 a month or $1,200 a year with a dividend yield of around 4%, you would need to invest about $30,000. Yeah, I know, that sounds like a lot. But the good news is, you don't have to reach that amount overnight. Start small, invest consistently, and reinvest your dividends to compound your income over time. Let me give you a practical example. Suppose you start with just $1,000 and add $200 every month. If your chosen ETF has a 4% yield, you'll be earning small dividend payments along the way. Over a few years, as your portfolio grows and you keep reinvesting, those dividends will compound and snowball into more significant income. Some popular high-dividend ETFs to consider are SCHD, VYM, and SPHD. SCHD is known for its reliable dividends and solid growth. VYM offers a broad range of high-yield stocks with stability. SPHD focuses on low volatility and consistent income. And the great thing is, these ETFs are more diversified than individual stocks, helping to reduce your risk while keeping your cash flow consistent. Dividend ETFs are particularly popular among long-term investors because they strike a balance between income and growth. Want to learn more about choosing the best dividend ETFs? Make sure to subscribe and hit the bell so you don't miss our detailed breakdowns and comparisons. Next up is peer-to-peer lending. This is where you lend your money to individuals or small businesses through platforms like Lending Club or Prosper. In return, you earn interest payments on your investment. It's a way to act as the bank and get paid for lending out your funds. To generate $100 a month, you typically need around $12,000 to $15,000 invested with an average annual return of 8 to 10%. It sounds like a big chunk of change, but many platforms let you start with as little as $25 per loan. This means you can spread your risk across multiple borrowers, reducing the impact of a single default. Let me break it down with an example. Imagine investing $1,000 across 40 different loans, each yielding about 8% annually. Even if 1 or 2 borrowers default, your other loans are still generating income, balancing out the risk. This is why diversification is key when it comes to P2P lending. But remember, peer-to-peer lending does carry risk. Not every borrower will repay, so it's crucial to do your research on each platform and diversify your investments. Some platforms even offer automated investing options that allow you to set your risk tolerance and let the system handle the rest. Peer-to-peer lending is great for those who can handle a bit more risk in exchange for higher potential returns. Just be mindful that liquidity can be limited, as some loans might take years to mature. Lastly, we have Covered Call ETFs. These are specialized funds that generate income by selling call options on the stocks they own. The income from selling these options adds to the regular dividend payments, giving you higher overall yields. To earn $100 a month, you might need around $20,000 to $25,000 invested, depending on the yield. Some popular covered call ETFs include QYLD, JEPI, and XYLD. QYLD targets high income through call options on the NASDAQ 100. JEPI combines covered calls with a diverse, actively managed portfolio. XYLD is similar, but focuses on the S&P 500. These funds typically offer double-digit yields, often around 10 to 12%. However, there's a trade-off: less capital appreciation compared to traditional ETFs. That's because when a call option is exercised, the ETF may have to sell its shares at a lower gain, limiting your upside potential. Covered call ETFs are perfect if you're more focused on steady cash flow than capital growth. They're particularly popular with retirees and income-focused investors who want reliable monthly payouts. So, there you have it. 3 realistic ways to earn $100 a month in passive income through Dividend ETFs. Great for long-term, consistent income. Peer-to-peer lending. Higher risk but higher potential returns. Covered call ETFs. Steady income with a focus on yield rather than growth. The key here is to start small, stay consistent, and reinvest your earnings. Passive income doesn't happen overnight, but the more you build, the closer you get to financial freedom. If you found this video helpful, make sure to like, subscribe, and hit the bell for more practical financial strategies. Leave a comment below and let me know which method interests you the most, or share your own passive income ideas.